Hooty hoo, all my stock market gamblers. Welcome today. I'm Tall Mike. I'm so glad you're here. Well, I hope everybody had a good weekend. What do we got going on in the markets today? Well, the Dow's down about 40. NASDAQ's up about 80. The S&P kind of hanging in there right around the 4,300 level. Now, a lot of people think this is the new bull market. A lot of people think we're going to rally to new highs, right? We're at 4,300. The old record was 4,700. So we're about 400 points off of that high. Now, is it possible? Yes, that's possible. Stock market, anything's possible, right? Now, a lot of people are quick to point out that I got this wrong. Look at when we were plugging away at the 41 to 4,200 level, I thought we were going to drop. I thought we were going to come back in. And we got this little bit of a short squeeze going up higher. Yes, I got it wrong. Now, if you got it right, congratulations. But what I want to talk today about is how not to get wrecked when you get things wrong. Look it. I have a small short position on the S&P, right? And it got short squeezed up. I was wrong. But my position was small because the trade never started working. It was from 4,100 all the way back in March up until now. We were just fluctuating right around that 41 to 4,200 level. And now we got the short squeeze up. Yes, I still have a small position on. But where do you go from the small position to the big position? You go when the trade starts working in your favor. This trade has never started to work in my favor, so I still have the small position on with the small loss in the S&P. Now, when does the trade start to work in your favor? All right, so there's this 20-day moving average. Now, for me, in my trading technique, I wait for the trade to drop, like I'm short the S&P, I wait for it to drop below the 20-day moving average. And it's got to stay there for 2 days. 2 days without coming up and touching the 20-day moving average. This has not happened since back in March. This whole time I've had this small position on, and I want to put a big position on, but I'm waiting for it to drop down below the 20-day moving average. Now, with the short squeeze moving up, it's pulling the 20-day moving average up higher. So when it does come down below that, it will be at a higher level, and I think my profits will be greater. I do not mind taking a loss on a short position I have, a small loss. The small position is what starts the trade, and you wait for the trade to move in your favor. Now, a lot of traders out there will tell you they hit 8 out of 10 winning trades, and some of those traders still lose money because they have big losses on the 2 trades that don't go their way. Now, there's other traders that will lose 8 out of 10 trades, but on their 2 winners, they will be so big that they will still be profitable. These are 2 types of traders. You want to be the one that can make money even if you only hit 2 out of 10 trades. Now, you're probably going to hit a lot more than that, but if you can limit your losses to small and then maximize your gains, you jump in more as the trade starts working in your favor. This is just how I do it. Of course, you have your system, and of course, if your system's working, stay with it. It's great. But anyways, that's moving on now to the real estate market. Everybody loves to talk about the real estate market. All right, so Redfin comes out and they announce that the average mortgage in the United States has hit a record high. I think it's right around $2,600 a month. $2,600 a month is a new record for mortgages average in the United States. Now, right now, mortgage rates have gone from 3% to over 7%. And that's if you got a good credit score. Like an 800 credit score, you can get a mortgage around 7%. You got a 700 credit score, you're going to be paying closer to 8%, right? Now, let's say you're paying 8% on the average price home. Now, I'm just using rough numbers. Let's call the average price home about $400,000. So, all right, $400,000, you put down, let's just say 10% down, right? So you come up with a $40,000 down payment, and you got a a mortgage for $360,000 at about 8%. Once again, rough numbers. Your monthly payment's about $2,800. All right. Now, most people are buying homes a little above average. Let's call it $500,000. All right. So $500,000, 8%. Your payment's going to be up around $3,500 a month. Now, that's a lot of money, right? You have to make approximately $120,000 a year income to qualify for that loan. And that's only on a $500,000 house. A lot of people can't afford to qualify. And this is what's going to send prices lower. Now, a lot of people don't believe prices are going to go lower. Of course, not in your area. They're going to go up. But across the nation, they started to come down. And I think they still have about 40% to the downside to go to come back to the long-term average. All right. Now, what's going to bring these down? Well, I think it's going to be the investor market. Now, the investor market is off by 50%. 50% from this time last year, investors are buying 50% less houses. Why? Well, because interest rates are important to investors. They just are. That's what investors look at. They look at three things, all right? They look at the prices of the homes they're buying. They look at interest rates, what those are, and they look at how much rent they can rent the home for. And now some of it doesn't start to make sense anymore. And that's why we're down about 50% in investor purchases. In some areas, it's down as much as 60, 70, 80%. The investors, they're running away. Why? Why are they going away? Well, because they're losing money. They can't flip the house for more money. You see, a lot of these corporate investors, they have absolutely no expertise in the real estate market, in the residential market, if you will. Companies like Redfin, companies like Zillow, they tried it. They tried to make money, but they're losing so much money that they're getting out of the business. Open Door, they're on the verge of bankruptcy. They need to have local knowledge of the real estate market to become a house flipper, to become an investor. Now, investors, they're starting to become the bag holders because the prices are starting to come down and these investments aren't making sense. Heck, you can get 5% on your money right now and just put it in a money market. So the investor compares that and they're going, well, wait, why am I doing all this work and losing money when I can just put it at 5%? So the investor's going away. All right. Now, I talk a little bit about the commercial properties, right? Commercial properties have crashed. They're down already about 50% off because they're sitting 70% vacant in San Francisco, in Los Angeles, these big high rises. You can get them for about half the price they were selling for about 3 years ago. So they've come down 50%. Everybody goes, of course they did. Of course they did. But people say, oh, houses can't come down. They can't come down by 50%. And well, that's your take. Now, my take is that they can. And now here's why. I want to talk a little bit about multifamily. Now, these are apartment buildings, right? And apartment buyers, people that purchase apartment buildings, they look at the price of the apartment building, they look at the interest rate, and they look at the rents that are coming in. Okay, so let's say that you were in a syndication. Now, there's syndications out there like Blackstone, BlackRock, and a company like Grant Cardone's got syndications where you put up the money and he goes and buys the apartment complex. So he was out there buying the apartment complexes when the rates were at 3%. Okay, so let's say you go buy a $10 million apartment complex. Rates are 3%, and let's say you put 30% down, right? So you put $7 million down and you buy this $10 million apartment complex and the rates are 3%. Okay, well now, how do you get your money back out? Well, what's happened is the rates have gone from 3% up to almost 8% for commercial loans. So if someone were to buy that same apartment complex now, they would be buying it with an 8% loan. Was 3%, now it's 8%. But the rents, they've gone up a little bit, but not much, not a lot. They're actually starting to come back down, and we're going to talk about that in a second. But going from 3% to 8%, what's happened to the cost of that apartment? Well, there's these things called cap rates, right? And well, basically, I'll just simplify this. It means that now that they are paying 8%, investors do not go out and buy apartment complexes with cash. They want the write-offs. So they buy it with the loan, and the loans are now 8%. So it doesn't make sense to buy it at $10 million. A lot of these apartments have already dropped down 30, 40, 50%. So let's say you got a $10 million apartment complex, and now it's only worth, well, $5 million. Okay. So, but you put $3 million down, but now you can sell it for $5 million. To get out of this apartment complex, you would have to bring $2 million to the closing table because the rates have shot up. Well, a lot of people go, well, we can't do that. We're going to hold on to it. Well, here's what's happening. A lot of people in these syndications, they're not getting paid. You see, they gave the money to the BlackRock, to the Blackstone, to the Grant Cardones. Okay, they gave them the money expecting to get this monthly dividend check each month because they collect the rent, so they get the dividend checks. And their exit strategy was to sell the property in 5 years. Well, 5 years ago, they bought at 3%. Now we're at 8%. Now that property's come down by 50%. I'm using rough numbers. Well, they can't get out because they'd have to go back to the investors and go, hey, you got to put more money in to get you out. Well, how much money do I get back? Oh, no, that money's all gone. You've lost all your money. We need more money to sell the apartment building. So these people aren't getting paid. They're not getting paid their monthly check, and they can't get out of it without putting more money down. They've been wiped out. Now, of course, the promoters of these, they're fine. The people like BlackRock, Blackstone, they get paid when they buy the building, and they get paid to manage the building, and they get paid when they sell the building, but they're not getting paid when they sell the building because they were going to take a big piece of the profits. Well, there's not profits anymore, right? There's no profits to be had, so they're not getting that, but they're still fine. The promoters are still fine. Now, here's BlackRock and Blackstone. Okay, Blackstone's got this $69 billion fund, right? And they're saying, people, you can't get your money back. For 7 straight months, they have not allowed people to withdraw. Now, these are rich people, but even rich people want to get their money back, and they're not paying them the monthly dividends that they were promised. So a lot of these people that invested in these syndicates are very upset because they're pretty much wiped out. Their money is pretty much gone, what they put into it, because they bought it was $10 million, and now it's almost cut in half. These multi-family apartment buildings. And now what's going to happen when the rents start to go down? But Mike, rents never go down. Well, you know what? They're actually starting to go down. They're going down in my area, San Francisco Bay Area. The rents are coming down. Things are for lease. And here's why they're coming down on houses. Okay, so rents are starting to come down on houses because people are locked in at 3%, right? They don't want to give up that loan. Now, let's say they get job transfer across the country. Well, I'm not giving up my 3% loan. I'm going to rent the property out. So they're renting the property out. More properties are coming onto the marketplace. Airbnb people, a lot of these people are getting in competition with the people that have that 3% loan, and the Airbnb people are losing money now. So they want to get out. The investors running because they're not making money because the rents are starting to drop. The vacancy rates are starting to go up. There's a million new units being built that are coming onto the marketplace this very year. Now, these are apartment building units. These aren't houses, but there's a million units that are coming onto the marketplace. What's this doing? It's reducing the price of rents. Rents are actually starting to come down. Now, I know in your area, rents only go up, and I get that. You live in this great area, and that's cool, man. I like that. But in a lot of areas, the rents are starting to come down. So here's what you got in the investor world. You got rates going from 3% up to 8%. I think they're going to push up to 9%. A lot of people don't agree with that. They go, but Mike, rates can't go up that high. Well, they can. They can go a lot higher. You don't know what you gotten into when you go from 3% to 9%. That's a triple. And when you triple the rates, there's a lot of problems in the economy. The banks are they're going to get so frozen up because of the commercial property. properties, because of these apartment loans that are coming due, because of things like this, the banks, they are not going to have any money for the residential loans to loan out to the houses so someone can buy your house. Well, that brings in the cash buyer. You got to buy the house with cash now. And that's going to send the prices spiraling down. Oh, no, yeah, prices are going to spiral down. Now, once again, this is my take. A lot of people get upset when I say stuff like this, and I understand that in your area, prices only go up, but the rents are starting to come down. The rates are up. Now, what's the third thing? The third thing is price. Well, okay, if rents are coming down and rates are going up, what's going to happen to the prices? Prices are going to come down. Prices of these apartment units are going to come down. Prices of houses are going to come down. The investors are running for the exit. Now, the first ones out, they're going to get a price that's close to what Billy Bob got. They're going to make it out within 10% of where Billy Bob got out. But if you wait too long, there's going to be circling the drain. Now, this is the oh crap moment where you realize, oh crap, homes aren't going up. They're going to come down. Now, a lot of you out there think home prices are going to double from here. And that's great. I just don't know who you're going to be selling the homes to because they become unaffordable. Now, this is just my take. I know that a lot of people don't like this view. A lot of people just bought a house and they're going to be really sad when their equity gets wiped out. A lot of people are in these syndications with these apartment syndicators and all their money's lost because they put it in and the cap rates have changed now and the interest rates went from 3% to 9%. And this has, when you raise rates that quickly, well, they raised the Fed went from 0% to 5%. I think we're over 5 now. And anyways, when they do that, there's this lag time. The lag time takes about 9 to 12 months to feel the pain. But we're already starting to feel it. We're starting to see it. Look what's happened is the banking system, Silicon Valley Bank, First Republic Bank, Credit Suisse, all these banks are falling over. But you see, all these banks were doing the same thing as all these other banks. These other banks just haven't come market to market, mark to market. They have to mark their assets down to market value. They're insolvent. They're bankrupt. They need bailouts. Everybody needs bailout. But you know what's cool? We've raised the debt ceiling so we can print as much money as we want and we can bail everybody out. It's a great country we live in. I love it. I hope you enjoyed this today. If you did, give me the thumbs up. Why not? Get out there, everybody. Enjoy your Monday. Bye-bye now.